Thanks for clicking! Canada should take steps to introduce longer mortgage terms to avoid potential payment shocks at mortgage renewal. This according to a new report from Desjardins.
Don't you dare!
Indeed, the report comes as the Bank of Canada is warning about steep mortgage payment increases in 2025 and 2026, with some mortgage holders set to see their mortgage payments increase by as much as 60%. Yet, the report from Desjardins says that had 10-year mortgage terms been available back in 2020 and 2021, those payment shocks would be much more manageable. And yeah, I think there's a large portion of Canadians that would have been more than happy to lock in at a 30-year 2.8% mortgage like the US was able to in July of 2021, back when over 51% of Canadians were piling into variable rate mortgages.
Not on my watch.
So what I want to do today is go over the report from Desjardins, discuss some of the obstacles to Canadians getting those 10, 20, 30-year mortgages, and then go over some implications. If Canada does ever get those 10, 20, 30-year mortgages, we'll obviously have an update out on those terms on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. Onto the report. Desjardins begins the report by noting that Canada doesn't have those longer mortgage terms like those found in the United States, as over the past 40 years, we've had a declining interest rate environment, and households were incentivized to borrow shorter term. However, says Desjardins, the abrupt shift to a higher interest rate environment has not only been traumatic for some households, but also shows the limits of Canada's mortgage system. Mainly, says the report, the need for Canadians to consistently renew their mortgages leaves the country vulnerable, as were inflation to tick up again, and the Bank of Canada had to raise interest rates in response, we could start to see more forced sales and defaults. And that makes sense. The Bank of Canada is already projecting major payment increases in 25 and 26, and those projections are based off current market expectations. If those expectations were to be pared back, if inflation ticked higher and the cost of borrowing went higher as a result, we could see even more increases than those being projected by the Bank of Canada.
We don't know.
However, this is not the case in the United States, or France for that matter, both of which have systems in place which allow the mortgage borrower to secure a fixed rate for the entire life of the mortgage. As such, Desjardins says that Canada should start giving consumers the option to secure a mortgage for longer than 5 years. Which, just briefly, Canadians already have the option of getting a mortgage longer than 5 years, as shown on the RBC website, although the cost of those longer than 5-year mortgages are ridiculously expensive, as shown on the RBC website. I think what Desjardins means is that Canada needs longer-term mortgage options, which are actually attractive.
No, not that.
Desjardins says that there are 3 main obstacles preventing Canada from getting longer terms at reasonable rates. First, banks and credit unions largely fund their mortgages off bank deposits, meaning the money that you and I put into our savings accounts at 0.1% interest.
It's all I can afford.
However, up until 2020 at least, the CDIC, which guarantees everyone's deposits up to $100,000, only guaranteed term deposits for up to 5 years. As such, it's been difficult to incentivize depositors to leave their deposits at the bank for a term longer than 5 years. Second, prepayment risk, in that the Interest Act restricts penalties for prepayment to 3 months interest on loans exceeding 5 years. Now, very briefly, I'm pretty sure that Desjardins was incorrect in his calculations that if a borrower were to prepay after 2 years on a 10-year mortgage, the penalty would only be 3 months interest, as, according to the Act, borrowers only have to pay that 3 months interest if they break the mortgage after they've paid for that initial 5 years, as in they pay that 3 months interest during years 6 to 10, but that's neither here nor there. The point still stands. The prepayment penalties enforced by the Interest Rate Act act as a disincentive for lenders to lend at longer terms at reasonable rates. If I lend money out for 10 years at 5% and then at year 6 the interest rates are 2%, you pay me back, I can only lend that money out for 2%. I've lost 5 years of opportunity.
I am never going to financially recover from this.
Definitely fair enough. Regardless, the third, final, and probably most important reason why Canada doesn't have these longer mortgage terms at lower rates is that Canada lacks a rich securitization market. And by this, Desjardins means that Canada lacks the tools for banks to package up these mortgages in a manner that would make them attractive to other investors.
I don't want it.
As mentioned earlier, right now at least, Canadian banks depend largely on deposits to fund their mortgage lending, which they can't really lend out dependably at 10, 20, or 30 years. As such, were Canadians to want longer mortgage terms at reasonable prices, the banks would need to find another source of funding, vis-a-vis mortgage securitization. Mortgage securitization, the process of bundling up pools of mortgages and selling them off to investors, as it stands right now, is extremely limited in Canada. We have Canada mortgage bonds, which we've talked about at great length before on this channel, though those bonds, as it stands right now, are currently only limited to insured mortgages. Under this program, the banks package up a bunch of mortgages into a single security, a mortgage-backed security, and sell them off to other investors, using the Canada Housing Trust as an intermediary. The banks get those mortgages off their books, get more funding, in order to lend out for new mortgages. However, the key limitation with this program is that it's limited to insured mortgages only, those mortgages which have less than 20% down, which, as of right now, only constitute about 25% of Canada's overall mortgage market. However, says the report, there is another option, the use of covered bonds. Covered bonds are different from mortgage-backed securities that we just went over, in that, with mortgage-backed securities, MBSs, all those mortgages are packaged into a single security, and those securities are sold off to another investor. With covered bonds, the bank issues a bond, a promise to pay, and the mortgages that back that bond stay on the bank's books. Meaning, the banks owe that money for that bond is collateralized by those mortgages, and the banks still hold on to the mortgages. Meaning, if one of those mortgages go bad, the banks are expected to replace it with a good mortgage. So, the bank bundles up a bunch of mortgages, issues a bond collateralized by those mortgages. If all of those mortgages go bad, the bank still owes the money.
This place got hit by lightning, huh?
So, this does effectively put more risk onto the banks. If those mortgages go bad, the banks are still responsible to pay back that bond, meaning so are their depositors. And, given this risk, OSFI, Canada's banking regulator, currently limits the number of covered bonds that these banks can hold to 5.5% of its assets. So, with Canadian banks constrained in the number of mortgages that they can put into these covered bonds, there isn't a lot of funding available, a lot of international funding available, to fund these longer-term, reasonable rate mortgages. Desjardins also notes that there are some demand problems for these covered bonds, and they're more popular outside of North America. Also, they're complex to set up, so it would make it more difficult for smaller lenders to get into the market. But I think the real barrier is that OSFI limits their use. And for good reason. If the underlying mortgages fail, if the underlying mortgages go delinquent, the banks, and I suspect you and I, are still on the hook.
Not going to happen.
So, as it stands right now, Canada does not have those longer-term mortgages at reasonable rates like they can get in the United States, due in large part to a lack of funding, as banks have to rely on deposits, prepayment risk enforced by the Interest Act, and the banks limited in their ability to securitize their existing mortgages, gain overseas investors. And what this really comes down to is who is taking the risk of lending long.
Not me.
Right now, if you want to break your fixed rate mortgage after 5 years, it's relatively inexpensive to do so. As such, there's more of a risk on the part of the lender, and therefore interest rates for terms longer than 5 years are higher. Were the Interest Act to be amended, that risk would be transferred back over to the borrower. Similarly, with OSFI currently limiting how many of these covered bonds that the banks are allowed to hold on their books, the banks are severely limited in the amount of risk that they can take, which, as we've seen, could very well be for good reason. Were we to move to a system more like they have in the United States, where you can get a 10, 20, 30-year mortgage at a lower rate, we would in fact see lower rates for longer terms. However, the flip side of that coin is that we would also see more risk borne by the taxpayer. We would be socializing the risk of these mortgages, as I suspect, if those mortgages went bad, we would all be on the hook for the bank holding them.
Yeah, probably.
So, in essence, this is all about transferring risk being borne by the banks, by the lender, onto the borrower, onto the society at large. And if Canadians and the borrowers want to take on more risk, that takes the risk off the shoulders of the banks, off the investors, and as such, they'll offer lower rates for longer. With that said, let's take this back full circle to Desjardins' initial argument that had 10-year mortgages been available in 2020 and 2021, we wouldn't be seeing as big of a payment shock in 2025 and 2026. Back then, you could get a 5-year fixed rate of 2.44 at a time when Canadians, more than half of which, were piling into variable rates. If Canadians weren't going to lock in at 2.44 for 5 years, what makes Desjardins think that they would be more likely to lock in for 10? With that said, if we do see major problems in 2025 and 2026, my guess is longer mortgage terms is going to be the proposed solution. And, even Desjardins notes, this will take a major policy initiative for Canadians to get those longer terms that they have in the United States. But, as we've seen today, make no mistake, this is all about risk transference. If borrowers are willing to take on that increased risk, that risk is no longer being borne by investors, no longer being borne by the banks, and as such, they'll lend their money cheaper. With that said, whether or not Canadians will get those longer terms at reasonable rates remains to be seen, but we'll obviously continue to track that on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.